people love to call rental property passive income. But let me ask you something. When the AC goes out in the middle of the summer and somehow always happens on a Friday afternoon or when you are on vacation, how passive does it feel? I own rentals, I do private lending, and both can make money, but they are not the same kind of passive. One gives you ownership and you become the landlord. The other lets you invest your capital and you act more like the bank. So today I want to compare private lending and rental property side by side so you can decide which one fits the lifestyle you're trying to build. Before I get into the comparison, let me tell you where I stand. I own rental properties. I am a private lender too. I have done notes, fix and flips, and owner financing, and I am not here to talk you out of either strategy. Both can work, but they do not work the same way. And most people do not fully understand the difference until they have lived through both sides. So let me break this down in a way that actually helps you decide. An easy way to understand the difference is this. With rentals, you own the asset, you own the house, you collect the rent, you pay the expenses, you handle the repairs, and you deal with the tenant. And if something breaks, it is your responsibility to take care of it. With private lending, you do not own the property. You actually lend money against the property. The borrower pays you interest. The loan is secured by the property. And if the deal is documented correctly, you may have rights similar to a bank, including the right to enforce your lien if the borrower stops paying. So from a high level, the difference is very simple. Rental property puts you in the ownership seat. Private lending puts you in the lender seat. And those are two different strategies. Let me break this down across 6 different areas. The first area is time. And this is the part most people underestimate before they get started. Most people compare investments by their return. And this is a valid metric, but maybe you need to ask yourself a different question. What is the return on your time? Because if you are a busy professional with a full-time job, or maybe a business owner, or someone trying to enjoy retirement, your time matters as much as your money. A rental property can cash flow and still take more time than you actually expected. Before you even own the property, you have to find the deal, run the numbers, get financing, maybe renovate the property, manage contractors, manage repairs. Then you have to find a tenant, screen the tenant, sign the lease, collect rent, and keep the property running properly. And that takes time. That is only one property. Just imagine if you have 5 or 10 just like that. Now you can hire a property manager. A lot of people think that will make everything easier, and sometimes it does. But a property manager does not remove you from the business. They just become the person who calls you when something needs a decision. The roof is leaking, the tenant wants to renew the lease, the AC is out, the repair is over the approved amount, the property taxes went up, the insurance jump. You may not be fixing the toilet yourself, but you are still the owner. And the owner still owns the problem. With private lending, most of the time is actually spent at the beginning of the process. You have to review the deal. You check the LTV or loan to value ratio. You agree with the borrower or investor on the actual terms, the interest rate. You make sure the documents are right. You have an attorney review them so everything is properly done. You close through a title company. And after that, if the loan performs as agreed, your role usually requires much less time. You just track the payments, you monitor the loan. At the end of the term, the loan might be paid off or it might be extended if both sides agree. And the property is collateral, which helps you protect your capital if something goes wrong. But you are not managing the property. That is a very different experience. And the return on your time is completely different too. Now let's go over area number 2, tenants versus investors. This is where rental property gets real very quickly. Rental property puts you in the people business. I do not say that in a bad way. Most of my tenants are very good people, but all it takes is one bad situation to cost you time, money, and a lot of stress. During one of my first rentals, I was hosting an open house when a nice lady showed up with her child. She was very sweet. She wanted a house instead of an apartment so her son could attain a better school district. I did a background check. I got a proof of income. I called the references. Everything checked out. But after 4 months into the rental, things started going sideways. She stopped making payments, then she paid only part of the rent, then she stopped returning all my calls, then she paid for 1 month, then she stopped paying again. Long story short, it took me several months to get that property back. Nowadays, I have better systems for screening tenants, so I do not have these issues as often. But the deal almost made me quit real estate entirely. When everything goes well on a rental, it feels great. You receive monthly cash flow, life is perfect. And today, most of my rentals are exactly like that. But even after years of experience, I still have difficult situations from time to time. A tenant can stop paying, a tenant can damage the property, a tenant can move out at the end of the lease and leave you with a vacancy for several weeks or even a couple of months. And the whole time, the mortgage still needs to be paid, the taxes still need to be paid, the insurance still needs to be paid. That is why I always pause when someone calls rentals passive. Sometimes they are, sometimes they feel like a second job with worse hours. With private lending, you do not deal with the tenants. The bank does not fix the toilets, and I'm pretty sure the bank is not watching YouTube videos at 9 p.m. trying to figure out how to unclog one, right? The bank does not repaint the bedrooms. The bank does not argue about security deposits. The bank gets paid according to the loan documents. Most of the time, as the lender, you are dealing with active real estate investors like myself who understand the business. And if you build a relationship with a person or investment company that has multiple deals, it becomes more like a business to business relationship instead of business to consumer. That is very different dynamic. Now, private lending still has risk. A borrower can pay late, a borrower can default, a deal can go sideways. I covered that in detail in one of my other videos. But your relationship is with the borrower, the investor, and the loan structure is what dictates the next steps if something goes wrong. When you compare dealing with tenants versus working with real estate investors, private lending is generally a more passive approach. Area number 3, income predictability. The third area is income predictability, and this is where the numbers tell the real story. With the rental property, the income looks simple on paper. Rent comes in, expenses go out. You keep the difference. But in the real world, that number actually moves. 1 month looks great. The next month, the water heater goes out, or there is a small roof leak, or the toilets are clogged. Then the insurance premium goes up. Then a tenant move out and you need paint, flooring, cleaning, and repairs before you can rent it again. So yes, rentals can cash flow, but the cash flow is not always smooth. It is tied to the property operations. From my experience, rentals start to feel more stable as a portfolio. When you have 1 or 2 rentals, 1 vacancy or 1 repair can actually hurt. When you have a larger portfolio, those issues can be absorbed across the entire group. For me, that number starts to feel more consistent around 10 rental properties. This is when 1 vacancy or 1 repair does not hit the whole thing as hard. So let me compare both scenarios with actual real numbers. Let's say you buy a $250,000 rental property and you put down $50,000. This is 20% down payment. If the rental nets $300 to $400 a month after expenses, that is around $7,000 to 10% cash on cash return before factoring in closing costs, reserve, or bigger repairs. Not bad, but one major repair or a short vacancy can wipe out several months of cash flow. Now compare that to lending the same $50,000 at 10% interest as a private lender. That produces about $5,000 a year, or roughly $417 a month in interest if the loan performs as agreed, right? Same capital, similar monthly income, very different experience. If this is done inside a properly structured Roth self-directed IRA, that income may grow tax-free as long as you follow the IRA rules correctly. Work with a qualified custodian and tax professional to understand what applies to your specific situation. Now, I want to be clear. Private lending has risk too. Borrowers can be late, defaults can happen. That is why structure actually matters. But the income is based on a set loan agreement, not a rent collection, property operations, and tenant behavior. That is one of the big reasons private lending appeals to busy professionals and retirees. They are not looking for another business to operate. They are looking for income that is easier to understand and easier to count on. Area number 4, capital and flexibility. The fourth area is how your capital is deployed, and this is part of the conversation most people skip over. With rental property, your capital is tied to the asset. You put money down, you may spend money on repairs, you leave reserve in the property, and over time, your equity can grow. That is one of the real advantages of owning rentals. You can benefit from appreciation. You can benefit from loan down payment. You may have tax benefits through depreciation. You may be able to refinance at a later time and pull capital out. Those are real advantages, and I want to be clear that I still believe in them. But your capital is usually tied for a long run. With private lending, the structure is a little bit different. You are lending your capital for a defined period, maybe sometimes 6 months to 12 months. That's a short-term financing, maybe 24 months or to 60 months. It depends on the deal. At the end of the term, if the borrower pays off the loan as agreed, you get your principal back. Then you decide what you want to do next. You can lend again, you can hold the cash, you can move into another opportunity. That flexibility matters, especially for investors who do not want to keep buying more properties just to grow their income. On the rental side, one thing I do over time is refinance properties as they appreciate in value. That can often allow me to pull out cash and redeploy it into more assets without triggering the same kind of taxable event as a sale, since refinance proceeds are borrowed money, not sale proceeds. I also use depreciation for tax planning. Sometimes I sell the asset and take the equity back. But if you sell, there might be taxes due on the gain. You might be able to use a 1031 exchange to defer those taxes by rolling into another qualifying property. But that is a strategy you need to handle with the right tax professionals. The big point here is this: rental properties can create wealth in several ways, but they usually require more active decisions along the way. Private lender seems easier, simpler. You lend capital, you earn interest if the loan performs, and if the borrower pays off as agreed, you get your principal back at the end of the term. Area number 5, risk. The fifth area is risk, and I want to be honest, because both strategies carry risk. The risks are just different. With rentals, you have vacancy risk, repair risk, tenant risk, market risk, management risk, insurance risk, and property tax risk, right? With private lending, your risk is tied to the borrower, the property, the documents, the lien position, and the loan to value ratio. This is why structure matters so much in private lending. A private loan should never be based on a handshake. It should be based on collateral, clean documentations, title work, insurance, proper closing, first lien position, and conservative LTV. In our deals, we want the private lender protected by a strong equity cushion from day one. If a property is worth $250,000 and the private lender is at $175,000, that is a 70% LTV That means there is $75,000 of equity above the loan amount. That cushion does not remove risk, but it helps protect the lender if something goes wrong. With rental property, you are managing the asset to create cash flow and long-term equity. With private lending, you are structuring the loan to protect your capital and create predictability, interest income. Both can work, but they are not built the same way. Area number 6, ongoing management. The sixth area is ongoing management. And this might be the biggest difference of all. A rental needs your attention on a regular basis. Even a good rental, you have to review statements. You need to approve repairs. You have to deal with lease renewals. If you decided to go with the property management company, you are managing the manager, meaning that you are outsourcing the work. One property may not feel like much. 5 properties feel different. 10 properties feel very different. If you have a business, a career, a family, or you're trying to enjoy retirement, you have to ask yourself a real question. Do I want more income if that income keeps requiring more of my time? That is not a criticism of rentals, it is just an honest question worth asking. Private lending is very different. If the deal is structured correctly and the borrower performs, there is much less to manage. You are not dealing with the tenants. You are not approving repairs. You are not worried about a vacant unit. You track your payments, you monitor the loan, and when the borrower pays off the loan, you get your capital back. Or if you decide to extend the loan, if both sides agree, that's okay too. That is why private lending can fit people who want real estate income without real estate running their life. The bank does not want to own the house. The bank wants the loan to perform. So let me go over the next part where rental property wins. Rental property has advantages that private lending does not. If you own the property, you can benefit from appreciation. You can build equity over time. You can get tax benefits. You may be able to refinance for better terms or pull equity out. You may have more long-term upside. Private lending does not give you all of that. As the lender, you earn interest. You get paid based on the loan terms, but if the property doubles in value, that upside belongs to the borrower, not you. So the question is not which one is better. A better question should be around your goals with your capital and how much time do you want to be involved in the day-to-day operation. Which one fits your lifestyle better? A 30-year-old investor building a portfolio may think very differently than a 62-year-old investor who wants income and less stress. A busy doctor, an attorney, CPA, or business owner may not want another operating business pulling out their time. A person who retired may not want to chase contractors or deal with tenant problems when the whole point was to enjoy more freedom. A real estate operator who loves the work may thrive with rentals because they understand the business and enjoy the process. They do this for a living, not just as a part-time side job. There is no one-size-fits-all answer. What fits your goals, your time, and the lifestyle you are trying to build. Only you can answer that. And this is where diversification becomes part of the conversation. A lot of investors think this is an either-or decision. Rentals or private lending. But for many investors, the answer is both. You can own rentals for long-term wealth building. You can use private lending for more passive structured income right now. That diversifies not just your capital, but your time. And here is the part that people do not like to talk about enough. Most investors think money risk, market risk, property risk, borrower risk, vacancy risk, but busy people carry another risk that doesn't get too much of a conversation: time risk. If your investments keep pulling you away from your work, your family, and your life, that has a real cost. If a rental is cash flowing a few $100s a month, but requiring ongoing decisions and attention, you have to ask honestly whether that trade makes sense for where you are going right now. That does not mean that rentals are bad. I recently spoke with someone whose entire goal was to build cash flow and equity through rentals. Sell those assets when they retired and they move into private lending for passive cash flow. For that person, rentals make complete sense right now. And private lending will make complete sense later on in time, not today. That is a smart portfolio thinking, and it is exactly the point of this video. Investments are not just about the highest possible return, they are about fit. Fit with your time, fit with your risk tolerance, fit with your goals, and fit with the life you're actually trying to build. My honest take, for me, after doing both, I look at this different ways. Rental property builds wealth through ownership. Private lending creates more consistent income through a structure. Rental property gives me equity. Private lending gives me more predictability each month. One strategy is not better than the other. They are just different tools at your disposal as an investor. And the best investors I know use both, but for different reasons at different stages of their life. So when someone asks me which one is better, my answer is always going to be the same. Better for what? If your goal is long-term equity and appreciation and you are willing to manage the responsibilities that comes with ownerships, rentals can make a lot of sense. But if your goal is more predictable income without tenants, repairs, and day-to-day property management, private lending might be a better fit for you right now. That mistake is not owning rentals. That mistake is calling them passive when they are not. Know what each investment actually requires from you, then decide if this trade is worth it at this stage of your life. And if you are thinking about doing this inside a self-directed IRA, private lending is one of the strategies that can fit within that structure. Your IRA might be able to act as the lender, and it may earn interest secured by real estate, tax deferred or tax-free, depending on your account type, without directly owning the property. Same conservative LTV, same first lien position, same structure. Just remember that self-directed IRAs come with their own rules. So work with the right custodian and the right professionals for your specific situation. I will cover this in a dedicated video soon. So which one is more passive? In my experience, private lending is usually more passive than owning rental property. Not because it has no risk, not because it is magic, but because you are not managing the asset. You are just lending against it, similar to how a bank operates. And that changes the entire experience. If you want to see more content like this, please subscribe to this channel. I cover private lending, real estate notes, self-directed IRAs, and real estate investing based on real experience with no hype. And I want to hear from you. If you own rental right now, do they feel passive, or are they more active than you expected when you got started? Drop your answer in the comments below. And if you want to learn more about how we structure private lending deals at JP Real Estate, check the link in the description or comment invest below. Take care and happy investing. Bye.